Picture this: you sit in a polished mahogany conference room on the 40th floor of a downtown skyscraper. A charismatic wealth manager in a bespoke suit slides a leather-bound folder across the table, smiling warmly as he says, "Our comprehensive management fee is only 1%. It sounds completely harmless. You think you are paying a minor annual tip for elite market navigation and peace of mind. But over a 30-year career horizon, that seemingly innocent 1% fee will silently confiscate over $580,000 of your family's compounding retirement wealth, while that same advisor does nothing more than put your money into standard index funds you could have bought yourself on your smartphone in 30 seconds. The traditional wealth management industry is built on a masterclass of psychological deception. They have convinced millions of hardworking professionals that managing a long-term investment portfolio is an impossibly complex dark art that requires a polished corporate middleman. But that is an exquisitely engineered marketing illusion. You aren't foolish for trusting an advisor, you are the target of an industry that weaponizes percentage framing bias to disguise massive wealth extraction as a harmless single-digit fee. My name is Nick, and I spend way too much time dissecting financial psychology, behavioral economics, and the invisible traps that keep smart people stuck on the financial treadmill. If you want to understand the real mechanics of money, cut through the noise, and build genuine financial autonomy, hit that subscribe button and give this video a thumbs up. Let's examine the empirical market data. Every single year, S&P Dow Jones publishes its SPIVA scorecard, tracking the performance of professional financial managers against the market. The data is devastatingly consistent. Over a 15-year period, more than 92% of actively managed mutual funds and wealth advisors fail to beat the simple, low-cost S&P 500 index. You are paying a premium price for mathematically guaranteed underperformance. How does the advisory industry maintain this multi-trillion-dollar extraction? It begins with the cognitive bias known as delegated complacency. Managing six-figure or seven-figure sums triggers deep psychological anxiety. Wall Street firms exploit this fear by manufacturing artificial complexity, distributing 50-page quarterly reports filled with opaque pie charts, standard deviation formulas, and proprietary asset allocations designed to make you feel helpless without their guidance. Then comes the brutal mechanics of reverse compounding. When you see 1%, your brain evaluates it as $1 out of every 100. But compounding doesn't work in isolation. That 1% isn't just taken from your returns, it is deducted from your entire principal balance every single year, whether the market goes up or crashes down. Over 30 years, that 1% fee compounds in reverse, stripping away between 30 and 40% of your total potential terminal net worth. Your mind uses mental accounting to rationalize this drain. You tell yourself, "I don't have the time to manage my investments," completely oblivious to the fact that maintaining a sovereign 3-fund portfolio takes less than 15 minutes a year. Now, let's look at the cold, hard math that exposes the catastrophic reality of AUM fees. Consider an investor with $500,000 in accumulated retirement capital, compounding over a 30-year horizon at a historical gross market return of 8%. Scenario A: they keep their money with a traditional 1% AUM wealth advisor. After deducting the 1% advisory fee plus average underlying fund expenses, their net annual return sits at 6.9%. After 30 years, their portfolio grows to approximately $3,710,000. Scenario B: they fire the advisor, open a direct low-cost brokerage account, and deploy that exact same $500,000 into a total market index fund charging a negligible 0.03% expense ratio. Their net return sits at 7.97%. After 30 years, Scenario B's unencumbered portfolio grows to over $5,030,000. That is a $1,320,000 difference. That isn't an opinion. That is math being brutally unforgiving. Scenario A paid over $1.3 million in lost compound freedom to a wealth manager whose primary job was rebalancing a portfolio once a year. When you surrender your compounding to an AUM percentage fee, you are literally giving away a third of your life's labor to an institution that takes zero risk on your capital. If the market crashes 30%, your advisor still collects their full fee from your remaining assets. This persistent loss of capital sovereignty keeps investors trapped in extended career servitude. You are forced to work 5 to 7 years longer just to recover the compound growth stolen by percentage fees. So how do you break the cycle? True freedom requires stripping away the middleman and embracing uncompromised direct self-custody. First, audit your financial advisory agreements immediately. If you are paying an AUM percentage fee, whether it is 1%, 1.25%, or even 0.75%, recognize it for what it is, an exponential drag on your family's future. Terminate the AUM contract and transfer your assets in kind to an established, low-cost zero-commission brokerage. Second, adopt the sovereign three-fund architecture. Deploy your capital into broad market, low-cost index funds, a total U.S. stock market index, a total international stock market index, and a total bond market index. This simple structure gives you total global diversification, zero manager risk, and an expense ratio near zero. Third, if you require specialized guidance for complex estate planning or business taxes, hire a fee-only, hourly fiduciary. Pay an expert $500 an hour for a one-time structural blueprint, and never surrender a perpetual percentage of your life's compounding. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today. Money isn't a complex corporate boardroom product or an opaque AUM fee. Money is stored time, direct sovereignty, and future freedom. Stop letting Wall Street middlemen take a permanent toll on your compounding. Start building an unshakable financial fortress today.